But our next guest says there may be more bad news to come for the U.S. economy. So joining us now is Seth Carpenter. He is Morgan Stanley's global chief economist. Seth, it's great to have you back on the show. And what do you mean by that? Especially as we do start to see some of the data, particularly the soft data, show signs of slowdown here.
Absolutely. So one of the things I've been saying to clients is that the market's probably got the right answer, but possibly for some of the wrong reasons. So we saw a lot of market reaction initially when we got the Atlanta Fed nowcast. We now, I think, understand where the wrong signal was there. I think there was a reaction first to the January retail sales report, but now that we've got the February one, we realize that that was a little bit of a head fake. And some of the softer data, sentiment, it can matter, but I tend to look at what people actually do. And I think the data don't yet tell us what's going to happen with the slowdown from tariffs. Ultimately, we've already seen 20% on China. We expect more to come there. We haven't seen the slowdown in the data yet from all of the layoffs of federal workers and cancellation or suspension of some federal payments. And we haven't seen the slowdown yet and the inflationary pressures from the restrictions on immigration. We think all of that is yet to come in the hard data, but the market sort of getting a bit spooked is probably a healthy thing. So they start to pay more attention to risks.
It's interesting to hear you say that because I think about the flash PMIs even today. You saw manufacturing numbers declining. You saw input costs ticking higher again. So, and it seems like a lot of that's in anticipation of what we're going to see with tariffs, pull forwards, ahead of some of those levies going into place. Am I reading that wrong? Or I guess what would you be watching most closely to know that we're realizing the full effects here?
Yeah, no, I don't think you're reading them wrong. And the PMIs, right, they do ask people who are making real world decisions about things that matter a lot. And so I think there's some informational content there. I just think from the pure macro data side of things, we are going to see it start to show up eventually more and more in the payrolls data. We're going to start to see it show up more and more in the consumer spending data. And that's going to be sort of reinforcing just how much of a slowdown we can get. I think people are looking for an all clear sign that we've seen the bottom, and I'm just not convinced we've got there yet.
You just mentioned immigration. The crackdown on immigration, you think that's going to be a drag on the economy here?
I do. We know for a fact, for example, that in 2023 and 2024, we had really rapid growth. Faster growth in the U.S. is typically able to sustain while still having inflation, especially services inflation, come down. That's because we had a big supply shock, a positive supply to the labor force, slowing the rate of immigration, in fact, possibly cutting it off entirely. That's got to go in the opposite direction. It means less growth than we would have had otherwise, and it's got to mean less ability for firms to lower prices. We're probably going to get back to a point where, at least in some industries, firms are saying what they said coming out of COVID. We're having trouble finding workers.
One of the things we did see with that surge of immigration, though, in the last couple of years is the fact that the wage increases largely went to, and we don't know what the breakdown is versus legal versus illegal, et cetera, but the wage increases that we did see in that data tended to be tied to immigrant workers. So if you see that start to come off, does that actually mean you're going to start to see wage growth re-trigger for Americans in the data? And if so, is that automatically inflationary?
So I don't think it's automatically inflationary. I mean, what we did see is the bottom half of the income distribution eventually start to get some wage gains. But remember, that wage gain started when we had the really, really tight labor market and businesses were forced to pay up in order to get workers. So I think that kind of dynamic is healthy for workers, especially at the bottom end of the income distribution. Maybe we start to see a little bit there, but I do think it does mean for businesses at the very least, some wage pressure, some cost pressures are going to come back at a time when I think lots of people were kind of hoping that we had got past the worst of those cost pressures.